Welcome back to Real Estate 101. Today we're going to continue our discussion on financial planning and talk a little bit about understanding investment risk. And I'm pleased to be joined once again by Gregory of Desjardins Financial. Jeff, welcome back to the show.
Thanks for having me again, Joe.
So Jeff, let's start today's show and talk about a little bit about investments. Are all investments risky?
Yeah, actually, every investment has some form of degree of risk within it. The only one that is very, very minor would be treasury bills, but you and I can't really get at them. Even GICs have an element of risk, and it's called interest rate risk, because if you bought something now, interest rates go up, you're going to lose somewhere along the time frame. So every investment does have a degree of risk, some less than others, but now it's just a matter of figuring out what kind of risk you're comfortable with to fit the investment that you need.
All right, so what is low risk investing?
Low risk investing will be something that will produce a very low rate of return very consistently. But typically you're not expecting anything heroic. If I use a baseball analogy, it'd be like going to the plate and getting a hit 9.5 times out of 10. GICs will be that, good strong short-term government bonds. You know what you're getting. You don't have to worry about what it is.
So it's more like just, you're playing the small ball game instead of
Pretty
going
much
for the grand slam.
Yeah, you keep bunting every time. You're not going very far, very fast.
Right, okay. So what about medium risk investing?
Those will be a combination of maybe some equities, some bonds. Balance funds are very common within the mutual fund industry, things that might produce some form of income that people need. So I'd say balance funds, things that hybrid, different types of the short and the riskier type of investments will mitigate the risk a little more evenly. Again, baseball analogy, it's like getting a hit 8 times out of 10. Yeah.
So what is high risk investing?
High risk investing would be taking a much bigger leap of faith. Things such as maybe getting into the stock markets, equity-based mutual funds, things that are more private placements. Even if you're lending money to people, it could be you're a second lender, getting into things where you don't have as much assurities. You're looking for a bigger bang for the dollar, but you're willing to take on that much more risk with the expectation that I may win, but the chances of losing. So again, back to my ruler, I usually say that 6 out of 10 times you're going to win, but there are 4 that when you lose, you strike out. Yeah. You don't even get a chance to make contact with the ball. You're walking back to the dugout with your head down. So that would be more of a higher risk investing.
All right. So we know with some of those higher stuff that they're a lot more riskier.
Yes.
What kind of rewards can people look for?
You could be looking, most people think of it as financial rewards. They'll be thinking that if I take on bigger risk, instead of getting 5%, I can get 50%. Think back to the .com in the 2000s, people were leaving their jobs because they can get 80% just day trading. Yeah. Those days are long gone, and we know what happened with that. When you're willing to take that risk, you could be rewarded, but you need to know when to get out. The gambler line, know when to hold them, know when to fold them, kind of does come into play with investing, and that is a great song or element of risk management right there.
So how does someone who's looking to invest, how do they figure out a comfort level?
Usually what we have is we have certain tools that we can use and have discussions with clients and prospects, and it'll help do a risk evaluation tool. So what we try to do is figure out what your comfort is, ask some questions about what your expectations are. How long do you need the money for? Is it something 30 years or is it something 3 months from now? That's going to determine sometimes the risk that you have to take as well. The shorter the period, the less risk. The longer the period, you can take a little bit more. And sometimes diversifying into many of the different types of risks lower your risk even. So right. There's a proponent to make sure just ask a lot of questions.
So how do taxes play a role in investing?
Taxes actually have a pretty significant role when you think about risk management. If you're in a high tax bracket and you're receiving interest income, you're going to be paying quite a bit, even though you're trying to be a little bit more conservative. So what happens is your net number ends up significantly lower. Sometimes that if you go with a little bit of dividends that have better tax treatment, you'll end up with more. Risk management and so forth is really concerned about what you end up with in the end, what goes in your pocket. That's the part that matters most. So when you think about risk, you also got to think about what you receive in the end. GICs, for example, may be deemed really, really risky, but when inflation is 2% and you're getting 1.5%, you're losing money.
Right.
The purchasing power is gone. So you actually take on a greater risk of having less money in the end by being pretty safe. So taxes can have a big part of this.
Now, going back to some of these strategies that you've talked about,
Yep.
are these the kinds of things that can keep somebody up at night?
Eating Taco Bell the night before will keep you up at night. If you've done a proper investment plan and took the risk and had these conversations, then no, you shouldn't be up at night. If you are up at night with your investments, you need to review them ASAP. Sit and talk with a certified planner like myself and make sure that you are doing what you think is best. Maybe you are not risky enough. I've come into that problem as well, seeing people in their 20s in GICs. That is not the right type of investment for those people. So no, if you are up at night, you're getting the indigestion and the heartburn, stop eating what you ate, and also probably come and talk with myself because you might need to have a bit of a portfolio review.
All right, so any final suggestions for managing risk?
The best way you can manage risk is just be realistic with what you want. Don't worry about what others did. Don't worry about what your neighbor did or what your family did or a friend or a coworker. It's about what you need it to do. And that's the primary focus, I think, at the end with risk management is it has to be personalized. Don't care what has gone on or what the newspapers say. It really is about what you need it to be and what you need to get in your pocket in the end.
All right, Jeff, good stuff. Thanks for coming on today's show.
My pleasure. Thanks again, Joe.
If anybody has any more questions or would like to diversify their portfolio, they can get in contact with Jeffrey Gregory at Desjardins Financial. I'm your host, Joe Terceira. Thanks for watching, and we'll see you next time.